I think the economy is in horrible shape. I think that's one of the reasons that President Biden is so unpopular, because I think a lot of the people who are struggling in this economy, in part, blame the president. He's not solely responsible, but he certainly hasn't done anything to help. Everything he's done is actually taken a bad situation and made it worse. But if you look objectively at the data, the savings rate is at the lowest it's been since 2007. I think it's down to 2.3%. So Americans have blown through all their stimulus money, and now they're pretty much broke. If you look at credit card debt, it's at an all-time record high. So Americans are struggling to put food on the table and to pay the electric bill, and so they're borrowing more money on their credit cards. If you look at what's happening to wages, they are declining in real terms. And I think the real decline is being masked by the fact that we are understating inflation. I think the actual inflation rate is about double what the government will admit to. And that means that the real decline in wages is much greater, which explains why so many people are now moonlighting. A record number of Americans have 2 and 3 jobs. In fact, you have more Americans than ever that are working 2 full-time jobs. And that's where all these jobs that are being created are going. They're going to people who don't want more jobs, but who are forced to take them anyway, because that's the only way that they can keep up with the rising cost of living. They're being very disingenuous, and that's a nice way of putting it about these numbers, because the implication is that, 260,000 people who didn't have jobs, who were unemployed, now they've got jobs. That's not what happened. All of those jobs went to people who were already employed. They are part-time jobs. That's what's happening. And it's not a great economy where people who have jobs need to get a second job. They would rather have the leisure. They would rather be able to spend more time with their families. But unfortunately, they can't afford that. They have to go and get another job. And that is where these jobs are coming from. If people come out of retirement, let's say somebody was retired, they're 70 years old, they were looking forward to just playing golf and going to the beach and hanging out with their grandkids, but now they have to go take a job at Target because that's the only way to pay the grocery bill. Do you want to brag about creating an economy where unemployed people are forced to go back into the workforce? The main reason that the unemployment rate is so low is so many people who aren't working are not counted as being unemployed. We have over 100 million working age Americans who are no longer in the labor market. But I'm sure a lot of the people there are just discouraged workers. You know, you don't count. If you've basically given up looking for a job because you don't think there's a job out there that you're qualified for at a wage that, makes sense for you to take the job, after a year, you don't count even in the U6 number, which includes discouraged workers and people who are only working part-time but would prefer to work full-time and who are still looking for full-time employment but can't find it. There, the unemployment rate, I think, is closer to 7%. But even that unemployment rate, once you've been discouraged for over a year, you're no longer counted in that number either. So I think if you objectively measured the unemployment rate and included all the people who are not working, but who would be working if they believe they can find a job, or who have settled for a part-time job when they prefer a full-time job, I'm sure the actual unemployment rate is in the double digits. The savings rate, again, is 2.3%. That's the most recent number that was released last week by the government. We haven't had savings that low since 2005. But one of the reasons that Americans weren't saving in 2005 is because they had so much home equity. They were just getting rich off the real estate. That was the peak of the real estate bubble. But right now, Americans are losing their home equity. Real estate prices are now falling. But what's more problematic is real wages are falling because the cost of living is going up and credit card debt has exploded. So if Americans really had all this savings, credit card debt wouldn't be skyrocketing. The reason credit card debt is going up so much is because people don't have savings. They can't afford to buy things. They have to borrow the money. But more of the money that they're borrowing is being spent on food. It's being spent on electricity, on gas. I mean, look at all the big retailers that are reporting that their customers are spending more money on food and less money on everything else because food is so expensive.
The credit card situation is scary. It's a sickening feeling to see those cards run up, and the people who run it up, the vast majority of people, I think, who have enormous credit card debt are buying things they do need, and they'd rather not have it on credit, but they don't have the cash. It's stomach turning to see the bills run up and to see the interest rates go up, and the interest rates go up and up and up. And I can only imagine it would make people feel kind of angry at the Fed for, every time they raise one of these rates, you owe more.
Yeah, you're looking at credit card rates now that are about 20%. And that is a huge amount of interest to pay. And, I think a lot of people today have a lot more consumer debt than just their credit card debt, because over the last few years, a lot of these buy now, pay later companies have come into existence. People are using those companies to buy stuff without money, but it doesn't show up in the credit card numbers because it's not credit card debt, but it's still debt that the consumer is obligated to repay. And I don't believe they're going to be able to do it.
It seems insurmountable. What happens? Is there some credit card default crisis that is the mirror image of the housing crisis? You referenced 2005 and going into the 2008 collapse. What's going to happen with all that credit card debt?
Yeah, the credit card debt is non-secure. If you don't pay it, the credit card company, they can't come after your assets. They can't put a lien on your house or try to go after your IRA. The debt is very difficult to collect if the person doesn't have any money. It's also dischargeable in bankruptcy. We haven't seen a big spike up in credit card delinquencies, but I think that's coming in 2023. And what also happens with credit card debt is once somebody with credit card debt recognizes that they can't pay it back and they've decided they're not going to pay it back or that they're going to file for bankruptcy, what they will do before is max out their credit cards. They'll just borrow as much money as they can because whatever they're buying, they're getting for free, right? So if you're planning on going bankrupt and you have $50,000 worth of credit card debt, but you still have another $50,000 that you can borrow, well, you're going to do it. You're going to go out and spend the other $50,000 and buy as much stuff as you can. Because when you go bankrupt, you don't have to return that stuff. If you go out and you buy a bunch of clothes and some consumer electronics or take a vacation, and then you file for bankruptcy, you don't have to give any of that stuff back. And it makes sense that before you file for bankruptcy to buy as much as you can, because once you declare bankruptcy, you're not going to get any new credit cards for a while. So you might as well buy everything you can before you go bankrupt. So you get that moral hazard that's going to accelerate the losses for the banks that are issuing the credit.
Explain to me why there are these predictions by you, by Jamie Dimon, of others, of an impending recession when the Fed is doing everything it can to prevent that. And we're seeing layoffs at companies. Is it not going according to plan?
I'm not even sure they have a plan, but I think we're already in a recession, and the rate increases are partially responsible for that. I think the recession is going to get a lot worse. Now, that doesn't mean the Fed shouldn't be raising rates. They should be. They should already have raised them a lot more than they have. The problem was they never should have cut them. That was the mistake. It was cutting rates. Raising them back up is really just an acknowledgement of that mistake. But what happens is when the Fed raises rates, it uncovers all of the problems that it created when it reduced rates. Because when it slashed interest rates to zero, it inflated a bubble economy, and it inflated it with inflation. Quantitative easing was inflation. It's just another word to describe inflation. It's just that a lot of people don't realize that it is inflation because inflation has a bad connotation to it. Quantitative easing doesn't sound as bad. If the Fed said our policy is to create inflation, the public would have said, wait a minute, I don't want inflation. So if they say, well, our policy is quantitative easing, then you don't have as many people critical of the policy. But we're now experiencing the consequences of that inflation, rising prices, and prices still have a long way to go. And that's one of the reasons I think that the recession is going to get a lot worse, because more consumer income is going to be diverted to necessities like food, energy, rent, insurance, things like that. And interest rates are going to have to keep rising. That's also going to take a lot of purchasing power out of the economy because people have to service their debt. And if you're spending money paying interest on the money you borrowed to buy stuff in the past, you have less money left over to buy stuff in the present and in the future. And that's what helps bring about a more severe recession. Most people's stock portfolios are going to continue to fall. Most people who own stocks, unfortunately, own the most overvalued stocks. Big tech, for example, those are the stocks that went up the most because interest rates were zero and people thought that inflation would be low forever. Well, now that interest rates are not zero and inflation is here and getting worse, those stock valuations are coming down. I think they still have a long way to fall. Most people will lose money in the stock market. I think they'll fare even worse in the bond market. Even though yields are higher now on bonds, they're not nearly high enough to offset inflation. People are going to lose a lot in bonds. So they have to start thinking outside the box and look towards alternative types of investing. You can still invest in stocks, but you can't invest in the indexes that are so dominated by overpriced tech names. You have to be more discriminating in the stocks you buy. You have to select the stocks based on value and dividend yield and just build your own portfolio rather than just, buying these indexes. And I think the best values are had abroad. I think the highest dividend yields are outside the US. And I think that also gives you the benefit of a hedge against what I believe is going to be a very weak US dollar. The dollar is up on the year, but it's losing those gains rapidly. But I think over the next several years, we're going to see a very weak dollar as the markets come to terms with the reality that inflation is not only going to get higher, but it's here to stay. It's not going back down to 2%. And that's going to result in a run on the dollar, I think, and on U.S. dollar-denominated assets, especially when the Federal Reserve actually has to go back to quantitative easing, which is creating more inflation because the economy gets so bad that it actually turns into a financial crisis. And now the Fed is under a lot of pressure to try to stimulate the economy. But the only way it can do that is by creating even more inflation. Just to point to the jobs that are being lost, these are full-time jobs, high-paying jobs with benefits. The jobs that we're creating are part-time jobs with low pay and no benefits. So it's not even trade-off when you look at the jobs we're losing and the jobs that are being created to replace those lost jobs. But I think this is just early in the layoffs. I think the layoffs are going to be very widespread. And in fact, some companies are going to be laying off 100% of their workforce because they're going to be going bankrupt. But a lot of companies are going to be laying off a lot of workers to avoid going bankrupt because they have to start cutting their costs. And one of the costs that they can cut is labor. When you cut your labor, you have to eliminate employees. And the reason for this is that companies' real sales are going down because their customers are broke, so they can't afford to buy as many products. And so the companies selling those products or services don't need as many workers to help provide those goods and services. And employers are looking at higher interest rates if they've borrowed money, which a lot of employers have borrowed money to buy capital equipment that they might need. Their rent might be going up, their office space, and their other raw material costs are rising. And so they have to figure out how to get by because businesses need to generate a profit because that's the way the owners of the business make money off the business. If they don't have a profit, they have to figure out how to create one or they're going to go out of business. And so one way would be to scale back the size of the business, and that means reducing your headcount. And that's going to go on across the economy. And of course, there are a lot of companies that never should have been created in the first place, that only were created as a consequence of monetary policy, of cheap money and the casino-like environment that the Fed created in the stock market. You have a lot of companies that have never made any money, but they have a lot of employees. Well, they were selling stocks to investors and they were using that money to pay their workers. But if the appetite for shares of money-losing companies is no longer there, a lot of these companies aren't going to be able to stay in business. And to the extent that they can stay in business, it will only be if they can dramatically downsize their operations and start generating a profit. And that probably means they have to eliminate most of their workforce. They have to go down. People buy homes. The vast majority of Americans who buy homes use a mortgage. They don't have the money to buy a house. They don't even have the money for a down payment. The average down payment has been, I think, 5% now. It used to be 20%, but people don't have the savings to put down 20%. They're borrowing the money. So the most important factor in home affordability isn't the price of the house, but the mortgage rate. And mortgage rates a year ago were in the low 3s. Now they're almost 7. You've had a doubling in the interest on a mortgage. And that dramatically reduces how much somebody can pay for a house. And so home prices are going to have to fall sharply because that's the only way anybody can afford to buy them. Now, of course, there won't be a lot of homes on the market for a while because people are not going to build them because it's too expensive to build them and people can't afford to buy them. And a lot of the people who own homes don't want to leave because if they sell their house, they can't buy another one because the mortgage on the new house could be double the mortgage they have on their current house. So they're kind of stuck. So that's helping to mitigate the supply a bit. But ultimately, I think the prices are going to be determined by demand and what people are able to pay. And with higher mortgage rates, they're able to pay a lot less. And so prices are going to come down a lot. And that means home equity is going to vanish for a lot of people who, are in their homes. They're not going to have all that equity. And that's going to have a big impact psychologically on their saving and their spending, on their ability to use their house as an asset for a loan or something like that. But even though home prices are going to be coming down, the cost of home ownership is going to be going way up, because even if you buy a house that's gone down 20 or 30%, based on where mortgages are, your monthly payment will still be higher than the payment would have been had you bought the house a year or two ago at a lower price, but with a much lower mortgage. Insurance rates are skyrocketing. I mean, the insurance on my own house in Connecticut in 1 year was up 40%. And people have sent me copies of their homeowners insurance that has gone up a lot more than that. So insurance costs are skyrocketing. Maintenance costs, if something goes wrong with your house and you need to fix it, the cost of repairing anything, the parts, the material, the labor, all of that has gone way up. Property taxes are going up. Your utility bill, the cost to heat the house, to air condition, everything is going up. So home ownership is getting a lot more expensive. So fewer and fewer Americans will be able to afford to own a home, let alone buy one. A lot of stuff happened at the peak of the bubble, but all that has to be unwound as the air comes out.